Hello everyone, welcome to MEA's e-learning channel. Today we will be introducing to mutual fund evaluation metrics. While investing in mutual fund is a very careful evaluation, it requires a very careful evaluation of making informed decision and choosing funds that align with your financial goals. Taking into this consideration, we have come across what are the documents that you have to view or you have to read while you are thinking of investment in mutual fund. At the same time, you also have to come across what are the evaluation metrics of mutual fund. So we'll explore the key metrics used to assess the performance and risk profile of mutual funds, making you an empowered investor so that not only do you understand the documentation but also the performance evaluation metrics. One of the major performance evaluation metrics of mutual fund is net asset value. It's also called as NAV. Is a per share value of mutual fund. We can say it's a per unit value of mutual fund also. It's calculated by dividing the total value of outstanding shares or outstanding units you have with the assets minus liabilities. So any assets that you have in mutual fund deducted from the liabilities and divided with the outstanding shares or outstanding units you hold in mutual fund. It gives you a per unit value of the mutual fund, and that per unit value is what we call as net asset value of mutual fund. So the formulation is very simple, the calculation is very simple. It gives you a good evaluation what is the value of per unit of mutual fund held by you, maybe at the end of the year or maybe at the end of the month, as and how you want to evaluate it. The importance of NAV is that it's a very crucial metric which reflects what is the underlying value of the asset. Even though your NAV may seem low as compared to the other, but if you see it from a basis of buying and selling of fund and shares, it's a very useful metric to understand whether you should be buying the mutual funds, whether you should be selling the mutual fund, or whether you should be holding the mutual fund. So it's a starting point of evaluation. Every mutual fund evaluation has basically is by net asset value. So you'll find an NAV for every mutual fund. If you want to see what is the NAV of mutual funds for every scheme, etc., you can find that in Economics Times Thursday. Every Thursday, the companies present the NAV or asset value of their mutual fund schemes. It's a performance metric. The calculation is basically done by the fund administrator at the end of each trading day, and it is reported the following day. So it's a dynamic figure. It's always changes, because as and how the market changes, your net asset value also changes. So you can't say that a net asset value will remain same every day. It fluctuates as per the market condition, as per the mutual fund performance, or as per the portfolio that the mutual fund manager has made for you. That is one important metric. That is NAV. The another metric that you have is total return. Total return is a mutual fund a return calculation based on your goals. So a short-term return, a long-term return, and an annualized return. A total return of mutual fund over a period of time, such as an year or a less, the fund's ability to generate gains. So when we say short-term returns or calculation of total returns in terms of short-term comes in money market mutual fund. For long-term, it basically comes for equity funds. So long-term return measured over several years. And there are many valuations for long term. You can go for CAGR, you can go for Sharpe ratio, you can go for Trenor ratios. These are also ratios which are calculated for long term. Then you can go for annualized return, taking into consideration the compounding effect. Again, CAGR can be used here. You can also go for tracking error method. You can go for several portfolio or standard deviation, for example, to come across what is the total return as well as the risk factor. So mutual funds are analyzed not only on the basis of total return, but is also assessed on the basis of total risk. So starting from portfolio ratios like Sharpe, Trenor, and Jensen, it also come across standard deviation and holding period HPR or AR for calculation. So we'll come across that like expense ratio. The next one is expense ratio. Now this is a very important factor while you're considering mutual fund investment. This gives you an exact idea about how much expenditure you'll come across while investing in a mutual fund. And the expenditure that you encounter in mutual fund or you incur in mutual fund is directly proportionate to the kind of returns that you will analyze in mutual fund. So it's like when you have a return, you always deduct expenditures from it to come across to your actual returns. So when we say net returns of mutual fund is where you deduct your expenses. So an expense ratio is a kind of liability of mutual fund for you, for as an investor. So you have to know what exactly is your liability when you're investing in mutual fund. So it covers fund operating expenses, management fees, administrative costs, entry exit load, the benchmarking ratios, impact on returns. Like expense ratio has an impact on returns. So whatever has impact on returns should also be well defined and well informed to you. So this is one of the metrics that you come across while evaluating mutual fund. Then you have alpha. You call it as Jensen alpha. One of the important metric in evaluating the performance of a mutual fund. Jensen alpha basically takes up beta as a calculation for the performance evaluation. So beta is basically volatility, of impact of volatility risk. So Jensen alpha is a measure of RAR. RAR basically is risk adjusted performance or risk adjusted returns. And you always consider RAR in mutual fund performances evaluation. It's a difference between what is the actual return and what is the expected return based on the level of risk. So when you say RAR is basically how much is your returns as compared to your risk. So alpha gives you a clear idea about how much practically what is the risk that you're taking and what is the returns that you're what is the return the fund is giving as per the risk. So is it viable to continue with the mutual fund if the risk factor is high and the return factor is less? Is it a good idea to have a high risk but also a high return portfolio? So these decisions can be easily made with the help of alpha number. The interpretation is like higher the alpha. The positive, the alpha basically means it has outperformed the benchmark. A negative alpha means it has underperformed the benchmark. So an alpha is always compared to a benchmark. So it's a very valuable metric for evaluating fund managers' skill. Then you have beta. As I said, beta is a measure of volatility. It's very sensitive to market movements. It's typically a measure of risk, volatility we say, and it's represented by a benchmark index. If the beta is greater than 1, it indicates the fund is more volatile. If the beta is less than 1, it represents that the fund is less volatile. So whenever you have a beta around 0.68, 0.98, 0.88 for example, then your beta is good because it's less than 1. But if you have a beta around 1.9, 1.10, 1.15 or somewhere above 1, it says that the beta, your fund has high volatility. So it gives you an idea about how closely the fund is volatile as compared to the market. It's a risk assessment tool. It gives you overall risk profile of a fund, how might it perform in different market condition. Investor can use beta to align a fund's risk character with their own risk tolerance. So you will always like to select a fund with a beta of less than 1. And this is easily available on the website. These informations are calculated and given to you so that you make a better fund decision. Then you have Sharpe ratio. It's a more popular ratio for a mutual fund. It gives you an overall assessment of risk and return. Sharpe ratio takes standard deviation as a denominator, and it takes risk return portfolio returns and risk-free rate as its numerator. So it's a example of RAR, risk adjusted returns. It gives you a complete comparison on benchmark index. And as always, higher the Sharpe ratio, higher it is suggested that the fund generates more returns. In all these ratios, whether it is alpha, Jensen, Sharpe or Trenner, higher the ratios, higher the better performance of the fund. So we always go for a higher portfolio ratios, whether it is Sharpe, Jensen, Trenner or Pharma. And it gives you an idea of risk adjusted return, especially Sharpe ratio. Sharpe ratio takes standard deviation, which gives you an overall measure of risk and return. So it is comparatively a good ratio to consider while you are selecting a mutual fund. You have standard deviation again. It's a statistical metric which involves the measuring of risk as well as return. So it quantifies the volatility of risk as per the fund's return, and it gives you a very detailed insight into whether there is high risk as compared to high returns. The investors can assess the risk profile as well as the returns profile. So this is where the comprehensive information is given by standard deviation. It gives you relative comparison also for benchmark index, helping the investors to get an idea ki what is the variation towards or deviation between the risk and return. Like what is the difference between the risk and return of a fund. So standard deviation is a metric which is very useful in assessing mutual fund performance. Other than that, there are many other metrics that is used by different fund managers. They use a combination of these metrics also. At the same time, they use different metrics for different schemes, or at the same time, they use all the metrics for all the schemes. So this is up to the fund manager how they want to evaluate the performance, but these are the basic metrics that every fund manager or every mutual fund schemes offer the investors. So one of the metrics is that you have to understand is NAV, how to calculate NAV, the portfolio ratios, the expense ratios, standard deviation, beta, alpha. These are some of the basic matrices that you have to understand while you're thinking of investing in mutual funds. I hope you understood the topic. Thank you very much.